When most retail traders think about hedge funds, they imagine massive bets, insider advantages, and secret algorithms. But what truly separates hedge funds from individual traders is something far more subtle. It's their ability to manage risk with surgical precision through delta-1 trading and advanced options hedging techniques. Today, we're going to uncover how hedge funds use delta-1 strategies to control exposure, manage risk, and profit from flows that most traders don't even notice. Welcome to Derivatives Trading Mentorship, the channel where we open the playbook of banks, funds, and market makers. If you want daily access to proprietary delta and gamma hedging levels, visit www.derivativestrading.com, where professional data meets actionable strategy. What is delta-1? At its core, a delta-1 product is any derivative that has a delta very close to 1. That means its price moves almost 1-for-1 with the underlying asset. Think of products like, for hedge funds, these are powerful tools. They allow funds to gain or hedge exposure without actually owning the physical asset while still tracking its movement almost perfectly. But here's where it gets interesting. Hedge funds don't just use delta-1 for exposure. They use it as a foundation for risk management. Why hedge funds rely on delta-1? Hedge funds operate with portfolios that often include complex options books. Every option carries a delta, and across thousands of contracts, net exposure can quickly become unbalanced. Delta-1 products give hedge funds the flexibility to neutralize or adjust risk instantly. If a fund sells call options creating short delta, they can buy futures to neutralize the exposure. If they're running a volatility strategy, delta-1 allows them to keep directional bias close to zero, focusing only on volatility harvesting. In pair trades or index arbitrage, delta-1 instruments serve as the backbone for balancing risk. Without these tools, funds would be exposed to wild swings in the underlying market. With them, they control exposure to the decimal point. The link between delta-1 and options hedging. Now let's connect delta-1 directly to options risk management. Every option has a delta which changes as the underlying price moves. Hedge funds are constantly monitoring their portfolio's net delta. A portfolio with even a slight delta imbalance can suffer huge losses if the underlying moves sharply. Funds can't afford to guess direction, they need neutrality to protect capital. This is where delta-1 desks come in. Using futures or swaps, funds dynamically hedge their portfolios, maintaining near-perfect neutrality. And when combined with gamma hedging, they can anticipate how delta will change with price moves. It's like playing chess while retail traders are still playing checkers. Practical example: imagine a hedge fund sells $100 million worth of S&P 500 call options. That leaves them with significant short delta. To hedge, they buy S&P 500 futures, a delta-1 instrument. Now, their book is delta neutral, but as the index rises, their short calls gain more delta, forcing them to buy more futures. This feedback loop of hedging flows is what often drives market momentum, especially around key strikes. Retail traders may think it's random, but it's simply institutional risk management in action. Why retail traders struggle without this knowledge? Most retail traders don't track delta exposure across the market. They trade based on charts, news, or intuition. But hedge funds, they see the hidden plumbing of the market, the flows created by delta and gamma hedging. Without understanding delta-1, retail traders are often blindsided by moves that were entirely predictable from an institutional perspective. That's why professional data makes all the difference. How we provide the edge. At Derivatives Trading Mentorship, we calculate proprietary delta and gamma hedging levels every single day. These levels show where hedge funds and market makers must adjust their risk. They're invisible to retail traders, but they shape the market's direction. By understanding these thresholds, you stop chasing candles and start trading in alignment with institutional flows. That's why so many traders rely on our insights at www.derivativestrading.com. It's the same playbook hedge funds use, delivered in a format you can actually apply. Final takeaway. Delta One may sound complex, but its role is simple: precision risk management. Future swaps and ETFs give hedge funds instant tools to hedge exposure. Combined with delta and gamma modeling, they create a near-perfect defense against market swings. For traders, understanding these mechanics is the difference between being surprised by the market and anticipating its every move. If you're serious about trading like a professional, subscribe now to Derivatives Trading Mentorship. We'll continue uncovering the institutional strategies hedge funds don't explain but rely on every single day. And if you want the actual proprietary levels hedge funds are watching, visit www.derivativestrading.com and gain the data advantage that moves markets. Because in professional trading, risk management isn't just protection, it's profitability.